Richtech Robotics is a company operating in the robotics and automation sector. Its stock ticker is RTRO on the Nasdaq exchange. The company designs, manufactures, and sells robotic systems. It also develops the software that controls these systems. Richtech serves several key markets. These include industrial automation for factories, warehouse logistics for e-commerce, service robots for commercial spaces. The company has become a subject of interest for many investors. They watch its performance as an indicator of the broader robotics market's health. Understanding Richtech offers a glimpse into the future of automated labor and its economic impact. The company was founded on the principle that automation can solve persistent challenges, including labor shortages, rising operational costs, the need for greater efficiency. To understand any company, we must first look at the numbers. Richtech Robotics recently filed its third quarter report for 2025. The report shows revenue of $150 million for the quarter. This represents a 28% increase compared to the same quarter in the previous year. For the full fiscal year of 2024, the company reported total revenue of $520 million. This growth rate is strong. It suggests that demand for its automation solutions is rising steadily. However, growth often comes at a cost, especially for technology companies that are investing heavily in research and development. The company is not yet profitable. It reported a net loss of $25 million for the third quarter of 2025. They spend heavily on engineering sales marketing to capture market share. The key is to watch the trend. The current loss is slightly smaller than the $28 million loss from the same period last year, which indicates a slow but steady move toward profitability. The company's cash position is also critical. As of September 30th, 2025, Richtech had $180 million in cash and cash equivalents on its balance sheet. The cash burn rate is a vital metric to follow. With a quarterly loss of $25 million, the current cash reserves of $180 million provide a runway of about, or nearly 2 years. This gives the company time to grow its sales and improve its margins before needing to raise more capital. The company's gross margin is currently 38%, a respectable figure for a business that sells hardware and software. The margin has improved from 35% a year ago, suggesting better cost controls in manufacturing and a higher mix of software sales. Another important indicator is the company's backlog of orders. The backlog represents signed contracts for future deliveries. At the end of the third quarter, Richtech reported a backlog of $400 million, up from $320 million at the end of 2024. A growing backlog provides some visibility into future revenue streams and shows that demand remains robust despite broader economic uncertainties. These figures paint a picture of a company that is growing fast and managing its finances carefully, though the path to consistent profitability is still a work in progress. The goal is to provide a clear and simple overview for anyone interested in the company, based on publicly available information as of today, October 20th, 2025. Richtech Robotics has a hybrid business model and generates revenue from two main sources. The first is the one-time sale of its robotic hardware, robotic arms for assembly lines, autonomous mobile robots for warehouses, and these sales make up the bulk of its current revenue. The second source is recurring revenue from software and services, software as a service subscriptions for its fleet management platform, maintenance contracts, and support services. This recurring revenue stream is smaller but growing faster and has higher margins. The company's strategy is to land new customers with its hardware, then expand the relationship through software and services. The robots are equipped with advanced sensors and connectivity, which allows them to collect vast amounts of operational data. Richtech's software platform, called Synapse AI, analyzes this data to help customers optimize their workflows and improve overall efficiency. This software component is a key differentiator. It locks customers into the Richtech ecosystem and creates a steady, predictable income stream for the company over time. A key innovation has been the development of its proprietary quantum vision system, an advanced three-dimensional machine vision technology that allows Richtech robots to identify and handle objects with greater speed and accuracy than many competing systems. The company holds several key patents related to this technology, which were granted in 2023 and 2024. This technological edge allows its robots to work in more complex and less structured environments. For example, they can pick mixed items from a bin, a task that has historically been very difficult for automated systems to perform reliably. Richtech has also formed strategic partnerships to accelerate its growth. In early 2025, it announced a partnership with a major global logistics provider to deploy its warehouse robots across several of the provider's distribution centers. This partnership not only provides a significant source of revenue, but also serves as a powerful endorsement of its technology. Richtech's product portfolio is designed to address specific needs in automation, and its flagship product line is the Orion series of articulated robotic arms. These are used in manufacturing for tasks like welding, painting, and palletizing. The Orion arms are known for their high payload capacity and precision. The latest model, the Orion 7, can lift up to 25 kilograms. It has a reach of 2 meters. It incorporates the quantum vision system, allowing it to adapt to variations on the assembly line without needing extensive reprogramming. So, this makes it suitable for factories that produce a high mix of different products. For the logistics and e-commerce market, Richtech offers the Nomad series of autonomous mobile robots. They navigate warehouse floors to transport goods from shelves to packing stations. Unlike older automated guided vehicles, Nomads do not require physical lines or markers on the floor. They use a combination of LiDAR sensors and AI-powered navigation to create their own maps and find the most efficient routes. The Nomad 200 model, released in late 2024, features improved battery life. It also includes a fleet management system that can coordinate hundreds of robots at once. The software is just as important as the hardware. The Synapse AI platform is the central nervous system for all Richtech products. It provides a single interface for customers to monitor and control their entire fleet of robots. The platform uses machine learning to analyze performance data and suggest improvements. For instance, it can reroute warehouse traffic to avoid bottlenecks, or adjust a robotic arm's motion to reduce wear and tear. This focus on intelligent software is a core part of the company's value proposition. It turns a simple robot into a smart, connected asset that improves over time. Finally, the company is venturing into the service robotics market. It recently unveiled a prototype called Aura, a robot designed for cleaning and security patrols in large commercial buildings. Aura uses the same navigation technology as the Nomad robots, but is equipped with different tools, such as scrubbers and high-definition cameras. While this product line is still in its early stages and not yet a major revenue contributor, it shows the company's ambition to expand beyond its industrial roots, and it represents a potential new growth area for Richtech in the years to come. This blend of hardware sales, recurring software revenue, and strategic partnerships forms the core of its business strategy. Richtech Robotics operates in a highly competitive environment. It faces pressure from large, established industrial automation companies. Fanuc, ABB, KUKA. These giants have vast resources, extensive customer relationships, global service networks, and they can often offer bundled solutions at a lower price point. Richtech's primary risk is being outcompeted on price and scale. To succeed, it must continue to innovate and offer superior technology, particularly in software AI, where it can differentiate itself from these larger, more hardware-focused incumbents. Another significant risk is the supply chain. The company's robots are built with thousands of components, including specialized microchips, motors, sensors sourced from various suppliers around the world. Any disruption to this supply chain, whether from geopolitical events, trade disputes, or natural disasters, can lead to production delays and increased costs. The company noted in its latest earnings call that it is working to diversify its supplier base. However, this remains a persistent vulnerability for any hardware manufacturer. Managing this risk effectively is crucial for maintaining production schedules and protecting margins. Despite the risks, the opportunities are substantial. The global demand for automation is growing rapidly. Aging workforces, rising labor costs, the need to bring manufacturing closer to home, are driving companies to invest in robotics. Richtech is well positioned to capture a piece of this expanding market. Its focus on intelligent, flexible automation solutions appeals to businesses that need to adapt quickly to changing consumer demands. The total addressable market for industrial and warehouse automation is projected to grow by double digits annually for the next several years. The company's biggest opportunity may lie in its software. While hardware sales can be cyclical, recurring software revenue provides stability and high margins. As Richtech deploys more robots, its network of connected devices grows. This creates a powerful flywheel effect. More data from more robots allows it to improve its AI models. Better AI makes the robots more valuable, which in turn drives more sales. If Richtech can successfully execute its strategy of becoming a software-centric robotics company, it could achieve a higher valuation and a more defensible market position compared to pure hardware players. Looking ahead 2 to 5 years, we can outline a few possible scenarios for Richtech Robotics. The outcome will depend on its ability to execute its strategy, navigate risks, and capitalize on opportunities. A balanced forecast should consider a base case, an optimistic case, and a pessimistic case. Each scenario hinges on key variables like revenue growth, profitability, and competitive positioning. This provides a structured way to think about the company's potential future. It is not a prediction, but, a framework for analysis. In a base case scenario, Richtech continues on its current trajectory. Revenue grows at a steady rate, 20 to 25% per year. The company makes progress on improving gross margins and slowly narrows its net losses. It secures a few more significant partnerships. Under this scenario, Richtech would likely need to raise additional capital once more before becoming self-sustaining. Its stock performance would likely be positive but not spectacular, tracking the overall growth of the automation market. The company remains a significant niche player. The optimistic scenario sees Richtech's technological edge translating into major market share gains. Its quantum vision system becomes an industry standard, forcing competitors to play catch-up. The company lands several large-scale contracts with Fortune 500 companies, causing revenue growth to accelerate to 40 to 50% annually. This rapid scaling allows it to achieve profitability within the next 2 to 3 years. In this case, the recurring software revenue becomes a much larger portion of the business. The stock would likely be re-rated by the market, leading to substantial appreciation as investors reward both rapid growth and a clear path to high-margin profits. In the pessimistic scenario, the risks materialize. Intense competition from larger players squeezes margins and slows revenue growth to below 10%. Supply chain issues persist, leading to production delays and cost overruns. The company's cash burn accelerates. A broader economic downturn could also cause businesses to pull back on capital expenditures, reducing demand for robotics. In this outcome, Richtech would struggle to reach profitability, and its stock value could decline significantly as investor confidence wanes. In summary, Richtech Robotics is a compelling company in a dynamic industry. Its future is not guaranteed. The numbers show a story of strong growth paired with ongoing losses, which is typical for a company at its stage. Its success will depend on its ability to continue innovating, scale its production, and manage its finances prudently. The path forward contains both significant opportunities for growth and clear risks from competition and external factors. For readers, the next steps are clear. It is essential to review the company's latest 10Q and 10K filings and listen to its quarterly earnings calls.